Right now, as you're watching this, 8 companies are worth more than the entire stock markets of Germany, France, the UK, and Japan combined. 8 companies. One of them, Nvidia, is worth over $5 trillion. Let that sink in. $5 trillion. That's more than the GDP of every country on Earth except two. And one man. The most famous CEO in tech, the guy who literally built the company at the center of all of this, looked reporters in the eye a few months ago and said the quiet part out loud. Are investors overexcited about AI? My opinion is yes. That was Sam Altman, the CEO of OpenAI, talking about his own industry. So here's the question nobody in Silicon Valley wants to answer honestly. Is artificial intelligence the greatest wealth creation event of our lifetime, or are we all watching the biggest financial bubble in modern history in real time and pretending we don't see it? By the end of this video, you'll have the receipts to decide for yourself. Let's get into it. Before we talk bubble or boom, you need to understand the sheer scale of money involved. Because this isn't a Silicon Valley story anymore. This is a global economic story. In 2026 alone, global spending on AI is projected to blow past $2.5 trillion, with roughly half of that pouring into data centers and physical infrastructure, land, buildings, chips, power plants. And by 2029, some forecasts put total AI investment at $3.3 trillion, growing at over 20% a year. Just 5 companies, Microsoft, Amazon, Alphabet, Meta, and Oracle, are expected to spend around $755 billion on AI infrastructure this year alone. That's not revenue. That's not profit. That's just what they're spending, betting that the payoff comes later. Put that in perspective. That's more than the entire annual GDP of countries like Switzerland or Poland, spent by 5 companies in 1 year on server farms and chips. And the reason this matters to you, wherever you are in the world, isn't abstract. This spending is reshaping electricity grids, reshaping job markets, reshaping the stock market indexes that your pension fund is probably sitting in right now. Which brings us to the scary part. Here's a number that should genuinely worry you, regardless of what country you live in. The so-called Magnificent 7 tech companies, Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla, now make up roughly 1/3 of the entire S&P 500. That's the index that tracks the 500 largest public companies in America. A third of it. 7 companies that the peak of the dot-com bubble in the year 2000. The crash that wiped out trillions and took the Nasdaq over a decade to recover from. The top 10 stocks made up about 25% of the market. Today, the top 10 stocks make up 35%. We are more concentrated in fewer companies, betting on one technology, than we were at the literal peak of the last great tech bubble. And this isn't just an American problem. Because of how global index funds work, if you have a retirement account in Canada, a pension in the UK, a superannuation fund in Australia, or a mutual fund almost anywhere in the world, there's a very real chance a chunk of your money is quietly riding on Nvidia's stock price without you ever having chosen that 0.1 bad earnings call from one chip company, and retirement accounts on 5 continents feel it. That's not opportunity. That's concentration risk on a planetary scale. Now, to be fair, and we're going to be fair on this channel, there's a real argument that this isn't 1999 all over again. During the dot-com crash, companies like Cisco were trading at 472 times their earnings at the peak. Pets.com had no real revenue model and burned through cash until it collapsed. The bubble wasn't really about whether the internet mattered. The internet obviously mattered. It was about companies with no business model getting billion-dollar valuations anyway. Compare that to Nvidia today. It's trading at around 44 to 47 times past earnings. Elevated? Absolutely. Insane like Cisco in 2000? Not even close. And unlike the dot-com darlings, today's AI giants are actually making enormous amounts of real cash. Microsoft, Google, Amazon. These are some of the most profitable companies in human history, and AI is layered on top of already massive, already proven businesses. The bull case in one sentence. This time, the companies at the center of the bubble can actually afford to lose the bet, and they're using their own cash, not just investor hype, to make it. Goldman Sachs and JP Morgan have both essentially said, the growth is real, The fundamentals justify it. This is a genuine technological revolution, comparable to electricity or the internet itself, and revenue from AI could exceed $1 trillion globally by 2028. That's the optimist case. Now let's hear from the people who think that case is dangerously wrong. Enter Michael Burry. If you watch The Big Short, you know this name. Burry is the hedge fund manager who correctly predicted the 2008 housing collapse when almost nobody else did, and made a fortune doing IT in late 2025 and into 2026. Burry came out of a long social media silence to do one thing: warn everyone that AI is a bubble too big to save. He placed a massive bet, over $1 billion in value at points, against Nvidia and the data analytics company Palantir. His argument isn't that AI is fake. It's that the math doesn't work. He's pointed out that Nvidia has become almost entirely dependent on a small handful of hyperscale companies continuing to spend hundreds of billions of dollars every year, essentially betting on each other. Big tech buys Nvidia chips. Nvidia's soaring sales convince investors AI demand is real. Investors pump more money into big tech. Big tech buys more chips. Round and round it goes. What some analysts now call a circular economy of AI spending, where the same handful of trillion-dollar companies keep passing money back and forth as proof of demand. And it's not just Burry. JP Morgan CEO Jamie Dimon and legendary investor Ray Dalio have both publicly said something feels off. Bank of America has an actual internal metric called the Bubble Risk Indicator. And in mid-2026, it placed the semiconductor sector at 0.91, edging dangerously close to historical bubble territory. Then there's this stat, and it should stop you cold. By multiple industry surveys in 2025 and 2026, roughly 95% of corporate AI pilot projects have failed to produce a measurable return on investment. Companies all over the world, not just in the US, spent billions rolling out AI tools internally, and the overwhelming majority saw no meaningful financial payoff at 95%. That's not a rounding error. That's an industry-wide reality check that the hype machine doesn't like to talk about. And even Sam Altman, the CEO of OpenAI, the company that started this entire wave with ChatGPT, has admitted he believes parts of the private AI startup market are in a bubble, even while defending his own company's fundamentals. When the man running the most important AI company on Earth won't rule out that his own industry is inflated, that's worth sitting with. This is the part most videos on this topic skip completely, and it's the most important part. An AI bubble bursting wouldn't just hit tech bros in San Francisco. Here's why this is a global story. Energy, data centers powering AI already consume enormous and rapidly growing amounts of electricity worldwide. Whole regions from Ireland to Malaysia to the American Midwest are seeing new power plants and grid expansions built specifically to feed AI computing demand. If AI spending suddenly reverses, entire local economies built around new data center construction, jobs, real estate, utility contracts get hit hard in towns that have nothing to do with Silicon Valley. Chips and manufacturing. Taiwan, South Korea, and Japan sit at the center of the global chip supply chain that makes all of this physically possible. When companies like Samsung and SK Hynix announce massive new manufacturing hubs to meet AI chip demand, Burry himself called that the beginning of the end of a cycle, because it signals the kind of overbuilding that historically precedes a crash. Markets. In June 2026 alone, the Magnificent Seven stocks together shed more than $2.2 trillion of market value in a single month, after weak guidance from a major chip maker spooked investors. $2.2 trillion gone in weeks from companies whose shares sit inside index funds held by ordinary investors in dozens of countries. Jobs. Beyond the stock market, there's a quieter global story. Companies on every continent restructuring, and in some cases cutting headcount, citing AI efficiency gains. Well before AI has proven it can reliably deliver those gains at scale whether you're in New York, London, Lagos, Manila, or Mumbai, if this bubble pops, you will feel it through your pension. through your job market, through the price of electricity. This isn't a Silicon Valley story anymore. It's everyone's story. Here's the honest answer, and I'm not going to pretend there's a neat, satisfying conclusion, because there isn't one. AI is real. The technology works. It is already changing how software gets built, how research gets done, how businesses operate. That part isn't hype, but the technology is real and the valuations are rational are two completely different questions. And history has shown us again and again that a society can be right about a technology's importance and still catastrophically wrong about how to price it. That's exactly what happened with the railroads in the 1800s. It's exactly what happened with the internet in 1999. The technology survived. Fortunes were still destroyed along the way. The uncomfortable truth is this. Nobody, not Sam Altman, not Michael Burry, not Goldman Sachs, not this channel, actually knows for certain whether we're in year 3 of a decade-long AI-driven economic transformation or month 12 of the biggest speculative bubble since 2000. But what we do know is this. When the CEO at the center of the entire boom won't rule out a bubble. When a 2008 crash caller is betting over $1 billion against it. When 95% of corporate pilots are failing to show returns. And when a handful of companies now represent a bigger slice of the market than they did at the last bubble's peak, you don't need a certain answer to know you need a plan. So here's what I want you to walk away with. Not panic, not blind faith, just awareness. Check what's actually inside your retirement account or index fund. You might be far more exposed to 7 companies than you realize. Watch the language coming out of company earnings calls in the coming quarters. If hyperscalers start quietly guiding down their AI spending, that's the signal analysts say to watch for. And most importantly, stay skeptical of certainty. Anyone who tells you with total confidence that this is either definitely a bubble or definitely not a bubble is selling you something that, if this breakdown helped you see the bigger picture, hit subscribe, because we're going to keep tracking this story as it develops, wherever in the world you're watching from. See you in the next one.